Ever since the pandemic started and Jerome Powell started the money printer, the stock market has only gone in one direction, up. This has trained millions of retail investors who started investing during the pandemic to constantly buy the dip. If a stock sells off 3 to 5%, it's time to buy. And if a stock sells off 10%, it's time to go all in. Ironically, when people buy these quote-unquote discounts, they're simply investing at all-time high levels from a few days or a few weeks ago. So it's not like they're really getting a discount. But we can't really blame them because that's all they've seen. In fact, throughout all of 2021, the S&P 500 didn't even experience a single 10% correction. The largest sell-off the index saw last year wasn't even 6%. So it makes sense that many retail investors have been trained to go all in on even the slightest of pullbacks. Many are even claiming that this is simply the new normal and that we'll never see another 40 or 50% correction in the stock market. But this is actually the most dangerous sentiment to have because the tops of bubbles are literally called the new paradigm. So here's the truth about stocks that don't come back. Starting off the list, we have the innovative companies or the growth companies that have dominated the market over the past 2 years. Often, these companies promise to revolutionize how we do everyday tasks. For example, instead of building up a strong network of taxis that's easily accessible, these companies will promise to provide you with self-driving cars. Or instead of building more stores and carrying more inventory close to where you live, they'll promise to deliver any product straight to your doorstep. Generally, these companies have the best of intentions, but they don't have the best of balance sheets. So it just takes a simple market downturn to wipe them out completely. Take Mark Cuban's Broadcast.com for example. In the 1990s, Broadcast.com allowed users to stream audio and eventually even video through the internet. Given that most of us spend hours streaming podcasts, music, videos, and movies today, this was clearly a great idea. And multiple $100 billion companies have been built based on just streaming one or two types of media. Yahoo could see this future in 1999, and that's why they agreed to buy Broadcast.com for $5.7 billion. But even Yahoo could not sustain the company through the dot-com crash, and they ended up shutting down one sector after another until they shut down the entire company. Another big bust from the dot-com era is Pets.com. The idea of Pets.com was simple. Sell pet toys and food through the internet to make these products more accessible and convenient than ever before. They had big investors on board like Amazon, who at one point owned half the company. This allowed Pets.com to complete an extremely successful IPO, raising over $300 million. Yet, just 268 days later, they went bankrupt thanks to the dot-com crash. Now, Pets.com was not a bad idea by any means. Chewy basically executed the same concept a decade later, and they're worth nearly $20 billion today. So clearly, the idea doesn't really matter when we're talking about a stock market crash. The only thing that matters during a downturn is the balance sheet, because if a company can't survive the downturn, they'll never actually release their quote-unquote revolutionary product or service. And that's just two examples. 52% of all dot-com companies went bankrupt by 2004, and there's no doubt that that included dozens of brilliant ideas. So clearly, simply investing in a company with a good idea doesn't guarantee investment growth. In fact, during the dot-com bubble, most of the time, it didn't. Okay, so betting on unprofitable disruptors is basically just a gamble. But what if you're not investing in unprofitable disruptors like Rivian, Lucid, Teladoc, and now Dimension? What if you're investing in profitable disruptors like Tesla, Shopify, and Square? These companies will most likely survive a multi-year bear market with no additional funding. So buying the dip on these companies is relatively safe, right? Well, if you hold long enough, then probably. But you could also be looking at several painful years ahead. For example, take a look at dot-com favorites that actually survived and ended up becoming big. Before Amazon became a trillion-dollar e-commerce giant and liberals started hitting Jeff Bezos, Amazon went through the dot-com crash. And Amazon didn't sell off 40 or 50 or even 70%. Amazon sold off a painful 95%. At that point, you'd probably be questioning if the company is going to survive regardless of how the balance sheet looks. But even if you stayed invested, you would have had to wait 7 years just to almost break even. And then the 2008 financial recession would hit, and you'd be down 70% on your initial investment once again. It wasn't until November of 2009 or 10 years after the dot-com peak that you would actually start making money on Amazon. Another great example is Booking Holdings. Booking Holdings was a travel booking company that went parabolic during the dot-com bubble, and it is still around today and it's doing better than ever before. But like with all companies that were founded during the dot-com bubble, it had to first go through the dot-com crash. And this time, we're not even talking about a 95% crash. We're talking about a 99.36% crash. This means that for every $100 you invested into Booking Holdings, you would have just 64 cents or not even a dollar left at the bottom of the crash. To make things worse, it took Booking Holdings 14 years just to recover to its dot-com peak. Also, it should be noted that even today, while Booking Holdings is at $2,000 a share, that's only a 2x from its dot-com peak, meaning that it took 25 years just to double your money. Even just investing in the S&P 500 would have given you a better return. Not to mention, you would have never been down 99.36%. So while you may not lose money if you go all in on a disruptor that survives, you could easily be waiting a decade just to break even. Okay, so disruptors in general are dangerous. You could either lose it all or you could end up waiting several years just to break even. But what if you don't even mess with the disruptor or growth stocks? What if you're a blue chip investor that only invests in the largest and most stable companies in the world like Apple, Microsoft, and Google? Is it okay to go all in on dips in this scenario? Well, not really. In fact, I'd say this is worse than going all in on a profitable disruptor. With profitable disruptors, you can be sure that if the company is able to weather the downturn, they're probably going to the moon once the market recovers. The same cannot be said about slower moving large cap companies. Here's the thing, while we like to often complain about companies being too powerful and having too big of a monopoly, companies don't stay at their peak forever. In fact, if you're gonna be deterministic about anything in the stock market, it should be that companies come and go. And with the rise of technology and rapid disruption, the lifespans of companies are getting shorter and shorter. In fact, McKinsey & Company found that the average time a company stays in the S&P 500 is just 18 years. Considering this, they predict that 75% of companies that are currently part of the S&P 500 will have disappeared by 2027. And even if they don't disappear, it's very likely that they become a shell of their former self. In the 2000s, the companies that dominated the Fortune 500 were GE, Exxon, Procter & Gamble, DuPont, and so on and so forth. While these companies are still around, disruptors like Apple, Microsoft, and Amazon have grown to be 10 times larger. But wait a minute, the market giants of the past like GE and Exxon weren't tech giants, so they had a tough time keeping up with tech. Companies like Apple and Google should have a far better shot at keeping up, right? Well, this is not exactly true either, and the best example of this is Cisco. During the dot-com bubble, it wasn't just speculative companies that got bid up, but also the biggest tech companies in the world. At the peak of the dot-com bubble, Cisco became the world's largest company, boasting a market cap of $500 billion. If we adjust for inflation, that's $823 billion today. Since then, 22 years have passed, yet Cisco is yet to put in a new all-time high. In fact, it's currently still 32% away from its dot-com peak, and that's with Cisco doing a bunch of stock buybacks and trying to soften the downfall. If we just look at their market cap, it's currently less than $250 billion, meaning that the stock has to run over 100% just to reach their peak market cap from 22 years ago. And that's not even accounting for inflation. Cisco isn't just a one-off exception either. Other top 10 companies that never recovered include Intel and AT&T. Who's to say that Apple isn't the next Cisco? I mean, have you seen the last 4 generations of iPhones? Only time will tell, but just keep in mind that going all in on tech giants may not be as safe as you think. And finally, that brings us to the index fund investor. If you're gonna constantly go all in on every dip, indices are definitely what you want to be buying. But I suspect that most people who are FOMOing into stocks aren't FOMOing into index funds. With that being said though, it's not exactly a good idea to FOMO into index funds either. Take the Nasdaq for example. After the dot-com bubble burst, the Nasdaq crashed a whopping 83%. Keep in mind that the Nasdaq is a combination of 100 of the largest and most profitable companies on the market. Yet, it was able to crash 83% within a few years. And it took a long and drawn-out 17 years to return to its dot-com peak. Many of you guys watching probably aren't even 17 years old. If you invested in the S&P 500 instead, you would have had a better time, but not by much. First, you would have experienced a 50% crash along with the 7-year-long wait to return to all-time highs. And just when you think things are finally going bullish again, you're hit with the 57% crash that takes you to lower levels than the dot-com crash. And it's not till 13 years after your initial investment that you finally start to make money. So as you can see, if you go all in at the wrong time, you could still easily be stuck for well over a decade even with an index fund. But at least you can be sure that index funds will recover sooner or later, right? Well, Michael Berry seems to think that index funds are actually in some sort of crazy bubble themselves due to the rise of passive investing, and that index funds are doomed to crash and not recover. But that's a whole nother discussion. So far, we've gone through several examples and hypotheticals, but the lesson at the end of the day is to just not FOMO into the market. Just because the market dips 10 or 15 or 20% doesn't mean that you should bet the farm on an index or any individual stock. This type of behavior is what leads to people losing money, resenting the stock market, and missing out on the best buying opportunity of the decade. By the time the stock market actually bottoms, they've either stopped investing or they ran out of serious capital a long time ago because they just kept buying it every dip. So what should you do instead? Well, this is not financial advice, but the smartest course of action in my opinion is simply a long-term weighted dollar cost averaging strategy. Maybe every week you invest $100 into the S&P 500. This way, regardless of what the market is doing, you have at least some money going into the market. This is extremely important because the only risk that's bigger than FOMOing in at the top is the risk you're taking by not investing at all. Anyway, going back to the plan, if the S&P 500 is down over 10% from its all-time high, maybe you could cut back on spending and invest $200 per week. And if it's down over 20%, maybe you can live on sticks and bones and invest $300 a week and so on and so forth. That's just one example of what you could do. There are several great long-term strategies that you can implement. It doesn't really matter which one you choose as long as you stick to it, don't let emotions alter your plans, and most importantly, don't be deterministic about anything, as no investment is too big to fall. But that's just what I think. Have you guys felt any FOMO in regards to the stock market within the last 2 years? Comment that down below. Also, drop a like if this video helped you realize how brutal the stock market can be. And of course, consider checking out our international channels to watch our videos in other languages, and consider subscribing to see more questions logically answered. But until then, I'm Hari, and I'll see you guys on the next one.